regarding IS 12 income tax and deferred tax, which is very important and crucial standards for reporting side. And I'm going to deliver you the fundamentals and basic aspects of IS 12. And I'm excited to guide you. So let me share my screen first. So yeah, IS 12 income tax, as I said, it covers covered current and deferred tax. A minute. So yeah, so basically IS 12 deals in two kinds of tax, which is current tax and deferred tax. Current tax is such kind of things like we pay to the custom authorities and we uh, uh, these taxes are paid to the custom authorities and we compute and make the tax liability. On the other hand, deferred tax is basically an accounting adjustment, which I will discuss in my further slides. So let's start with the current tax. Basically, the current tax is a tax, as I said, which is paid to our custom tax authorities. So for this purpose, we need to compute current tax with this equation, with this formula. So this formula has two components. One is taxable income and another one is tax rate. Tax income is different from the accounting income, and we need to compute this income from our accounting income. Basically, we prepare the financial statements according to the IFRSs and ISs. So for the tax purpose, we need to make some adjustment to drive our taxable income. So first we discussed how to compute taxable income or losses if in case. I will discuss this further why I write here losses, and then we will discuss the tax rate. So moving to the taxable income, we first need to understand that we have our accounting income. Like here I have made an example. Yeah, you can see here. So it is a basic profit and loss statement. You can see here. Here we have sales, cost of sales, gross profit, accounting depreciation, expenses, and our PBT. So we usually prepare this statement as per IFRS and IAS accounting standards. And here I've said that we need to compute the taxable income. We need to adjust some balances. So basically, tax laws do not allow such kind of expenses and income. So which we called admissible and inadmissible expenses. For example, here you can see that the accounting depreciation is 10 here. But for the tax purpose, they said, no, this should not be 10, this should be as per our accounting law, tax laws. So, for example, if our tax depreciation is 30 here, so we need to revise our computation. So for revising our computation, we need to compute for like taking this example here. Like for the PBT, we need to take first PBT, profit before tax here, which is 100. Then we need to add or less the admissible and inadmissible expenses. Like here, the accounting depreciation is not covered under the tax law, so we need to add back this. So in 100, we need to add back this. So it will be 110. Then the actual depreciation we need to recompute, which is 30. So ultimately, we will be at 80. Here I have made an computation for this. So basically, I'm saying that the taxable profit is here and the tax will be paid on 80, not 100. Uh, guys, I'm not listening anyone. So right now it is okay for you. Can anyone
From
respond me?
It's fine.
hello, hi.
Yeah.
From where did you compute 30?
Yeah, it was my just assumption
Oh,
because it is the tax depreciation is computed by the tax laws. Tax laws says that the depreciation should be computed by our laws standards. So I am assuming that the tax person says that you should compute tax depreciation on 30, not on 10. Therefore, we need to revise our computation. Okay. So far, any question? Am I going right? Because it is
Yes.
my first time here.
Yes,
Okay.
Osama, absolutely right.
Yeah,
We're
thank
getting
you.
your point.
Okay. Now, I have made an example here. So further moving to the previous example, I've made 3 years P&L, profit profit and loss statement as per accounting. So here you can see that I've drive same sales, cost of sales, gross profit, and then depreciation expense and other expenses, and then PBT. Like I said that the PBT of accounting is not taken under tax laws. So we need to revise as per the tax standards. Given here some more information regarding the accounting side, that we have a machine which cost at 90 at the start of the year, and it is depreciating over 3 years in our accounting policy. Basically, in our accounting policy side, every company determines the life of the asset. So here the company assumes that the life of this asset is going to be 90. So the depreciation per year will be 30. So here I have computed the PBT and I'm making the same in this slide. But as I said, for the tax purpose, we need to revise as per the tax purpose. So I've making the same example as I've covered in my previous example, that I've revised the depreciation here, which is 45. So we will get this result for the 3 years. So here you can see that the tax rate is 25% here and 25% here is the same. Here you can see that we have paid 21 to the tax authorities, not 25. So in total, you can see that the total tax is paid over 3 years is 75, right? Can anyone respond?
Yeah, so if we just little bit slower for the pace side, so it will be helpful all the stakeholders to understand the point here.
Okay. So yeah, that's why I'm asking that, is it okay now? Yeah. So yeah. Okay. So here you can see that for the tax purposes, the revised computation is 85 for the PBT, not 100. Therefore, the tax is calculated lower in the 2 years. You can see that here it is 25 as per the accounting standards, and here is 21 as per the tax standards. And here we have paid more tax, like we have paid 25 in 2025. Here we have paid 33 in uh, tax standards. So the difference of 4 and 8 is deferred. So I hope you are getting the right point. This is the deferred tax.
I
So
have a one question over here. Sorry to
yeah,
interrupt. Yeah, so like you mentioned out about the PBT of 85 and previously the PBT in 2023 is 100. Can you
yeah,
please little bit explain us that how you this profit has been changed
yeah, sure.
in detail?
Yeah, sure. As you can see that the total P&L is same except the depreciation. You can see that. The depreciation in example one, where we have computed the accounting income is 30 because of the accounting standards. We have a policy of depreciation for over 3 years. So as per the tax standard, depreciation is 45. That is why we need to compute the taxable profit for the tax calculation. Likewise, uh, the tax is computed 21, not 25 here. So the total tax is 75, but we get the benefit of 4 in the current year, which is called deferred deferred tax. which is called basically the temporary difference of timing, which I will cover later in my slides. So that is where the deferred tax concept arises. So what is the key point in the deferred tax is not a tax which is paid. Rather, it is an accounting adjustment. As you can see that the 4 which I calculated, the difference of 25 and 21 is 4, which is not going to be paid to the tax authorities. It is just an adjustment in our financials, so we can make our accounting adjustment, which will be settled later. That is why it is called the deferred tax.
I have a
The
question, Osama.
Yeah, sure.
So, as you said that the 4 is the temporary difference. So,
Yeah.
is it like deferred tax liability or deferred tax asset? Can you please explain?
Yeah, sure, sure. Just I need to briefly give brief concept of deferred tax. In my later slide, I will cover how it can be deferred tax asset and deferred tax liability. I've just write it here deferred tax, not an asset or liability. I will later describe you how it is asset or liability. Okay.
Sure, right.
Okay. So it deals with situations where the accounting treatment of a transaction is different from the tax treatment. Can anyone help me to understand this line with the previous example? How it is different?
Like
Because
in your yes, Danish, please.
um, in our accounting system, we are depreciating the asset over 3 years, and tax authorities say that
Yeah,
we should depreciate the asset over 2 years. So, this is why
exactly.
there's a difference.
Thank you, Danish. Right. So because of the accounting transaction, the treatment of accounting treatment is different from the tax treatment. Therefore, the deferred tax arises. And the last point is very crucial that the difference, if the difference is a permanent, like the tax penalties, which will never be settled after the accounting adjustment, then we should not account for the permanent difference. We can only cater the temporary difference in our deferred tax adjustments. So this is the basic idea of deferred tax. Moving forward to the deferred tax is computed on these 3 items only. The first one is temporary difference, which I have discussed in my example. As you know that uh, the accounting and tax treatment are different, then there that is where the temporary differences arises. Another treatment on unused tax losses. We compute deferred tax on unused tax losses, like the accumulated losses we have, and we've compute it over uh, deferred tax. But one thing here, we should know that if we have tax losses, so it is required that if we have assumption that it will be recoverable in the future years, like we will have profit in the future years, the probability of profit in the future years, then we can compute the deferred tax. Otherwise, the standard says that you are not allowed to compute deferred tax if you have no probability of profit in the future years. And the third one is this more or less same like unused tax credits, which is a term of tax they use. Moving forward to this, I've mentioned that the temporary difference. So basically, the temporary difference arises between the carrying value of accounting, like I've computed the depreciation on IFRS basis, taking the carrying value of uh, uh, taking the carrying value of IFRS and IS basis and less the tax base, like what we have computed as per the tax standards. I will give you example for this temporary difference, so it will be easy for us to understand how temporary difference is calculated. One more thing I would like to add here is uh, I have computed deferred income or deferred tax in my previous example this approach is called a PNL approach. There are two types of approaches in deferred tax. One is the PNL approach, profit and loss approach, and another one is balance sheet approach. So here you can see that I have computed temporary difference by taking the carrying value. Carrying value is a balance sheet item, as you all know that. So the carrying value like cost minus accumulated depreciation for in PP like. So we need to compute carrying values of as per IS and tax base to compute the temporary difference, and then we will multiply with the tax rate.
Osama, I have a
So,
question. If you can go to previous
Mhm.
slide, please.
Yeah, sure.
What is the difference between unused tax losses and tax credits?
So basically, unused tax losses is our accumulated losses which we are presenting in our financial statements. But
Hmm.
it must be the tax accumulated losses, not the accounting accumulated losses. As per I've said that if we have losses, which I have presented in my very first slide in the current taxes, I have mentioned that taxable loss. So if taxable losses are frequent in our previous years, it will be accumulated in 1 year. So we can compute deferred tax on our previous year losses, but it should be settled as per the tax laws which Abhinav have give the session
Hmm.
earlier. So they've said that. And unused tax credits are also kind of benefits which we get from our tax authorities. So if we have any kind of tax benefits, tax credits allowed by the tax authorities, so we can also compute uh, as an deferred tax. So it is a tax sum basically used for the deep tax calculation.
Yeah, mean the
Um,
tax losses are the losses which is accepted by the tax authorities, yeah, not the accounting
y-
losses.
no, 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 no.
Yeah, okay,
Yeah,
that's fine.
yeah. Yes, Ramsha.
Yeah, actually, I want to ask that if we have paid like penalty to the tax department,
Yeah.
so like is that considered while like calculating our current tax and deferred tax? So it will it be like considered as a deferred tax for this
Mm.
year?
No, no. The tax penalties is not a temporary difference. It is a permanent difference, and the tax authorities will never give you claim for the tax expenses. Therefore, this difference is a permanent, and it will not be catered in our deferred tax, and we will remove it from our P&L from the profit calculation.
Okay, okay, okay.
Yeah.
Someone can you allow me 1 minute?
Yeah. Sure.
Yeah. I just give you the one heads up, like what Shamsha asked for the temporary and permanent differences. So there is primarily two things, which is called a permanent difference, and second one is called a temporary differences. Deferred tax is always considered out for the temporary differences because it is a matter when we are thinking that the authority is not agreeing on the right now, but in the later years they will agree on these points. So therefore, we are calculating our benefits that we are obtain in the future, which is called a temporary differences. Just like Osama mentioned about property, plant, and equipment depreciation differences because of the useful life has been changed as per tax laws and as per accounting laws. But when we talk about the permanent differences are those differences which, as per accounting, it is fine, but as per tax laws, they will never ever allowed us in future in any reason. Therefore, we always saying out that if we have any kind of a permanent difference, we will not consider that the amount into the deferred tax. Similarly, Ramsha, you asked from the tax liabilities or any kind of the penalties that you are paying, even it will not be allowed in the current tax calculation. Like if we paid any kind of the penalties, fines to the authorities, it will even not consider it out in the current tax liability calculation or current tax expense calculation. So similarly, if the tax is not allowing us in right this year, so in the future, definitely the tax will not allow us. So that is why we are not considering any kind of the permanent differences considered out into the current tax as well as in a deferred tax. So I just want to add this thing in a more detail so everyone can understand the differences of there. I hope I can explain it out.
Yes, thank you.
Thanks, Habib, for the clarifications. Then, continuing to this, we have discussed the temporary difference as per the balance sheet approach, and then going to the tax rate. So, which tax rate should be used for the tax deferred tax calculation? So basically, while computing the current tax, we use the current year tax rate applicable for the current tax calculation. But for the deferred tax, we use the rate which are expected to apply when the asset are realized, liabilities are settled. So basically, it means that because we are calculating deferred tax, which will be settled in our later years. So we need to make sure that if there is any change in the tax laws and it is expected to be changed in the future laws, so then we need to take that rate which are applicable in the future years. So deferred tax will be calculated on the rate expected to apply. And one more thing here, it is that the deferred tax are not allowed to be discounted. We do not discount the future years deferred income or expenses. Then we have uh, yeah. So I guess Danish has asked me the question how to compute deferred tax asset and how to compute deferred tax liability. Here is it is our answer. So basically, to compute the deferred tax asset or liability, we need to identify that the carrying value and the tax base of asset or liability. So here is a formula. You can say that if your carrying value determined on IS and IFRS basis is greater than the tax basis, and if it is an asset, then it will be called as taxable temporary difference. So whenever you have the taxable temporary difference, it will be deferred tax liability. So you need to remember this equation to identify whether it is deferred tax asset or deferred tax liability. We will do some practice question later, so it will be helpful for us to determine whether it is deferred tax asset or deferred tax liability. Likewise, we have the detectable temporary difference. It is vice versa of this equation. Here, a carrying value is less than the tax base, so it is a deductible temporary differences, and it will result in deferred tax asset. Uh, any question so far? Yes, Hassan.
Hi.
Hello.
Hi. Hi, Osama.
Hi.
I have one question that you earlier said that we have two approaches, P&L and
Mhm.
balance sheet approach.
Yeah.
So either one which we follow, so would we
Mhm.
get the same answer?
Yeah. The answer would be same by both approaches, but in our accounting, I can say world, we usually follow the balance sheet approach more because the data is more easier to get and to compute the uh, just directly getting the carrying value of accounting standard than the text base, which is a more easier approach than the P&L approach. But the answer would be same.
Thank you.
Thank you. So moving further, I have made an illustration to understand more about the deferred tax. I make it more simpler and I'm using the depreciation in all example to understand easy way. So I have an example. Can anyone read this for me? Or I should pick anyone?
You can pick. It will be easier.
Okay. So, Mahin, can you read it for me?
Yes, sure, I can read.
Yeah, thank you.
BV Limited acquires a machine for a USD 4 lakh and decides to depreciate it a straight line over its useful life of 5 years. Income tax legislation in BV Limited country allows depreciating machines straight line over 4 years. In the year 1 to 5, BV Limited accounting profit and taxable income before depreciation expense is USD 200,000 and the tax rate is 20%. Required show BV Ltd deferred tax expense for year 1 to 5.
So, yeah. So basically, it is a basic example to understand how we will compute the deferred tax. So for this, here it is required the deferred tax calculation for 1 to 5 years. So we first need to identify the carrying value and the tax base. So here we can see that the accounting standard says that the useful life is 5 years. So the company is depreciating it 4 lakh over 5 years. But in income tax laws, it is allowed to depreciate over 4 years. So the depreciation would be different for income tax and accounting standards. Therefore, the deferred tax arises. So first we need to compute the carrying value. So our first step would be the compute the carrying value. So we will compute the carrying value by we need to calculate the carrying value as per IS 16, which is 4 lakh, and the depreciation would be 80,000 per year. So because the carrying value is taken here, so the carrying value would be 3 lakh 20,000. So I am putting here as a 3 lakh 20,000 above, and further we required to compute the tax base. And the tax base value with the same calculation, but changing the useful life, which is 4 years. So the carrying value would be 30,000. So the impact would be the difference would be 20,000 in those in both. So we need to check that the deferred tax here. Okay. So here we have calculated our deferred tax. So can anyone tell me, is it a deferred tax asset or deferred tax liability? As I've mentioned in my previous slide.
That's it, I believe.
Deferred tax asset. Yes, because it is an asset and the carrying value is higher than the tax base, then it would be the deferred tax liability because it is a taxable temporary difference. As you can see that the carrying value of asset is higher than the tax base, therefore it would be the deferred tax liability. And for the similar years, I have computed all this. Moving further, I've made an illustrations for identifying the deferred tax asset and deferred tax liability. So I've made an example of property, plant and equipment here that the accounting carrying value is 1 lakh and the tax base is 80,000. So the difference is 20,000. Accounting carrying value is greater than the tax base. So it is the taxable temporary difference. Therefore, it will be classified as the deferred tax liability. Another example of inventory provision. As you know that the tax authorities do not allow any kind of provisions as earlier discussion, Abhinav mentioned that the provisions are not entertained in the tax laws. So therefore, the tax base would be the zero. So we usually find a lot of times that the deferred tax is computed on the provisions. So here how we will compute the deferred tax asset or liability. So I write it here that our accounting carrying value is 200,000, which is a liability. So liability is higher than the tax base. So in our equation, you can see that the liability carrying value is higher than the tax base. So it will be fall under the deductible temporary difference, and then therefore it would be the deferred tax asset. Here it is mentioned. Okay, it is sorry. It is a liability. It is a liability. Yeah, it is mentioned it here mistakenly. I've copied the above one here, but it is a deferred tax asset here. And here it is the same case for the liability. You can see that the accounting carrying value is 50,000 because the tax authorities not accept any kind of lease treatment. Therefore, the tax base value would be 0. And we have a difference of 50,000. We will compute the deferred tax on this 50,000 by applying the applicable rate. So the accounting carrying value is greater than the tax base, so it should be deductible temporary difference. You can see that. Therefore, it would be classified as deferred tax asset. So how it will be presented in our financial statement, it looks like this, and we uh, disclose it like this statement. We do net our deferred tax asset and deferred tax liabilities as per the balance sheet approach, and you can see that we have computed deferred tax asset on retirement benefit obligation, sales tax return provision, inventory provisions, depreciation on fixed asset, and realized foreign exchange losses. And we have netted off both. So we have net deferred tax asset here, which is 98 million. So because this is a balance sheet item and this is the uh, closing value of our deferred tax asset, so the difference of opening and closing will fall under profit and loss statement. So our is made for this purpose to compute the deferred tax. Also, we can compute by P&L approach. The answer would be the same, but for the balance sheet approach, we make a movement of deferred tax here, and we take the beginning balance which we have computed in our last year, and we put our balance here, which is a closing balance. You can see that it is matching with above. So the difference of 96, 128, 967 is during the year profit or loss, which is parked in profit and loss statement. So this is a basic overview of deferred tax. Anyone have any questions? Is there anyone or my mic is mute?
No, no, your mic is not mute. I think we are good. We can move forward.
Okay. No, this standard is small, and this is the basic view of deferred tax. So this is the basic idea of deferred tax, and I want to cater some questions if anyone have.
Nothing, Usama.
Okay. So can I ask you any kind of question?
Yeah,
Just
you can.
just joking, just joking.
So
So
will
yeah.
there any additional session on like advanced deferred tax as well?
Yeah, deferred tax is basically the advanced deferred tax can be
No, I mean a little
mhm.
bit difficult stage after this basic session.
Yeah, we can conduct another session if you want to take an advanced session of the deferred tax. We will definitely uh, book another slot for this as well.
Actually, people in this call must also give us recommendations like on what topics and on what standards relating to IFRS and
Mhm.
um, IS, what they want to like learn, so that we can incorporate in our planning. How about that, Osama? Like
Yeah,
since
well,
Danish mentioned about the
mhm.
advanced deferred tax, so we can involve some difficult scenarios
Yeah,
for next session.
yeah,
Good
sure, for
insight,
sure.
Danish.
Yeah,
Yeah.
it will be good. Yeah.
Yeah. Yeah, Danish, do you have any specific scenarios that you are facing with deferred tax? Any
Not
specific
like
thing?
this. I just want like we had the basic session today. So
Mhm.
Yeah.
after that there will be some complex treatments as well. If we can
Hmm.
like guide others on that as well, so that if
Yeah,
anyone faces any challenges in future, it will
Hmm.
be helpful for them.
yeah. Good to mention it here. We'll definitely work on it and we'll conduct another session for the advanced level.
Yes, I just want to add one thing. Yeah, Danish, thank you for the insights. And it is also the same plan we have. That firstly for the complex standard, we just give you the brief idea about the basic level. And the next session, like 30 to 40 minutes, we will not discuss about the basic crunch. We will discuss only the examples pattern where we have 2 to 3 or 4 examples where we can discuss about the real life challenges and sort of things. So it will be helpful about 30 to 40 minutes more. So it will already plan out. So we will definitely in the upcoming sessions, we will consider that thing on a priority level as well.
So, okay. Thank you from my side. Thanks everyone for joining and hope.
And this is also a good idea
uh,
that
mm,
other than Habib is also giving the presentation. I like this idea. We can have
yeah,
Yeah.
other colleagues as well.
Yeah, in
yeah,
future you also see the other colleagues as well, like Ramsha, Osama, and
uh,
Wasim, Zishan. And if you're also interested out, connect with me. I will give you the presentation pattern
yeah.
because it is open for everyone. If someone wants to give the training sessions, we are
I was
happy to schedule these things.
yeah, I was about to taking his name as also.
Okay, thank you so
So
much.
yeah, thank you all.